You may think of money as just numbers, spreadsheets and math, or an equation that needs to be solved. But the real financial decisions are made far away from calculators, around dinner tables, shaped by ego, pride, fear, and personal history. True nature of money is the dance between the cold arithmetic of a spreadsheet and human nature. When it comes to money, we are complicated creatures, and financial success is not so much about how much you know, but how you behave. This reflection was inspired by Morgan Housel's brilliant book, The Psychology of Money. Let's delve into the strange and deeply human side of money. We all come from different generations, with parents earning different incomes and holding different values, living in various parts of the world, born into different economic environments, with varying incentives and opportunities. As a result, we all have very different experiences and attitudes toward money. Take the stock market and inflation, for example. People born in 1970 saw the S&P 500 increase nearly tenfold during their teens and 20s, leading most to view the stock market positively and become more inclined to invest. In contrast, those born in 1950 saw the stock market go almost nowhere during their formative years, resulting in a more skeptical or negative outlook. Similarly, people born in the 1960s experienced significant inflation during their youth, making them more aware of its dangers. Meanwhile, those born in the 1990s grew up in a time of low inflation and therefore tend to worry less about it. A person's experience with the stock market and inflation during their early years significantly shapes their attitude and behavior toward investing and financial decision-making. People justify every financial decision they make based on the information they have at that moment and the mental model of the world they've built, often passed down from parents and shaped by life experiences. Even if they are misinformed, lack knowledge, or make poor choices, these actions make sense to them within their own story. As Housel puts it, people do some crazy things with money, but no one is crazy. We all have unique worldviews, and since there is no universally correct way to manage money successfully, none of us are truly irrational. We make financial decisions based on our personal life experiences and our worldview. There is no doubt that Warren Buffett is considered one of the greatest investors of all time. What's staggering is that $81.5 billion of his $84.5 billion net worth was earned after he turned 65. Housel explains, few pay enough attention to the simplest fact. Buffett's fortune isn't due to just being a good investor, but being a good investor since he was literally a child. By starting to invest at age 10, Buffett harnessed the power of compounding, the quiet engine behind long-term wealth. Let's say you invest $1,000 at an interest rate of 8%. After 1 year, your investment earns $80, bringing your total to $1,080. If you compound that amount again at 8%, you'll earn $86.40 the next year. Now your total is $1,166.40. You're earning money not only on your original investment, but also on the returns you've already made. Over time, this effect becomes exponential. Compounding, however, can feel counterintuitive. Many of us underestimate how powerful it can be over decades. Warren Buffett began serious investing at age 10 and had a net worth of $1 million by age 30. Imagine if he had spent those early years like many young men in their 20s, traveling, buying nice cars, and enjoying life. If he started with $25,000 at age 30 and continued generating 22% annual returns until retirement at 60, his net worth today would be about $11.9 million to 99.9% less than his actual $84.5 billion buffets. Financial success comes not just from skill, but from time and consistency. His secret is not just investing well, it's investing early and never stopping. Consider Jim Simons, who has compounded capital at a staggering 66% annually since 1988, far higher than Buffett's roughly 20% average return. Yet, his net worth is only $21 billion to 75% less than Buffett's. Why? Because Simons didn't start seriously investing until he was 50, giving him less than half the time Buffett had to compound. Housel estimates that if Simons had invested for as long as Buffett, his net worth would be $63,900,781,780,748,16000 over $63 quintillion. Time and compounding are forces more powerful than even the best returns when it comes to money. We tend to lean toward pessimism. A 40% drop in the stock market over 6 months will dominate headlines, while a 140% gain over 6 years goes largely unnoticed. Good things take time and often don't happen overnight. Slow progress doesn't grab attention the way sudden disasters do, whether it's terrorism, plane crashes, or natural disasters. But despite setbacks, optimism is rational. Because when we look back, things have generally improved over time. So what is it about pessimism that we cling to? Because bad news shocks us, it grabs our attention. And because we evolved to avoid danger, we're wired to notice risks more than rewards. To be practical, we don't have to be pessimistic. Despite short-term losses or crises, we can believe that, over time, the odds are in our favor. When watching the news highlight a stock market crash, economic woes, or other money problems, try to remember that things tend to improve over time. In 1968, there were about 300 million high school-age people worldwide. Of those, only 300 attended a small school in Seattle called Lakeside, which happened to be the only high school in the world at the time with access to a computer, the teletype model. 30. That rare opportunity changed everything for one student. Bill Gates, from 300 million to 300 Gates, had a 1 in a million chance of being a high school student with access to a computer. He and his friend Paul Allen went on to create Microsoft. Even as a teenager, Gates was brilliant, hard-working, and visionary. But going to Lakeside gave him a 1 in a million head start. Gates himself admits if there had been no Lakeside, there would have been no Microsoft. What's rarely mentioned in the Microsoft origin story is another member of that group of teenage computer prodigies, Kent Evans. Just as intelligent, just as visionary. Kent could very well have been one of the founders of Microsoft, alongside Gates and Allen, but he never got the chance. A mountaineering accident took his life before he graduated high school. The odds of such an event? About 1 in a million. Just as Gates benefited from an extremely rare stroke of luck, Kent faced an equally rare encounter with risk, the close sibling of luck. Luck and risk are like wind and waves guiding a sailboat. The sailor controls the rudder and sails, but the direction and speed are ultimately influenced by external forces beyond control. Understanding that success is a complex mix of talent, effort, and chance helps us approach our own financial decisions with humility and perspective. People want to become wealthier to make themselves happier. But according to Housel, the key to happiness is the ability to do what you want, when you want, with who you want, for as long as you want. The pursuit of material wealth has led many to work harder and give up more control over their time, even though they're richer than ever. Studies show that having control over your life is the most dependable predictor of well-being, more than salary, house size, or career prestige. Ultimately, controlling your time is the highest dividend money pays. Pursuing money without valuing time is like filling a bucket with a hole in it. No matter how much water you pour in, it will continue to leak out. Similarly, no matter how much money you accumulate, it won't bring lasting happiness if you don't have control over your time and can't enjoy the fruits of your labor. Heinz Berggren fled Nazi Germany and became one of the most successful art dealers of all time. He collected works by Picasso, Klee, and Matisse. In 2000, he sold part of his collection for over 100 million euros. What was his secret? According to Horizon, a research firm, great art collectors buy vast quantities and hold on to them for decades. They wait for a few of those pieces to become famous and valuable, even though most remain obscure. In other words, it's not about being right all the time, but about diversifying and waiting for a few winners to emerge. Perhaps 99% of the works Berggren acquired in his life were of little value, but it didn't matter because the other 1% were masterpieces. These events are known as long tails, where a small number of outcomes account for the majority of results. This concept applies broadly, especially in business and investing. Take Amazon, for instance. In 2018, drove 6% of the return on the S&P 500, even though it's just one company. Much of Amazon's growth came from two-tail events, Amazon Prime and Amazon Web Services ADA. These two products alone more than made up for failed experiments like the Fire Phone. After the Fire Phone disaster, Jeff Bezos told shareholders, "If you think that's a big failure, we're working on much bigger failures right now." I am not kidding. Some of them are going to make the Fire Phone look like a tiny little blip. Bezos understands that it's okay to fail as long as the process creates the 1% of tail events that drive everything. Tail events are mostly hidden from us because we only see the finished product, not the countless failures along the way. Think of a comedian's Netflix special. You watch it and think, wow, this person is amazing. What you don't see are the hundreds of failed jokes tried in small clubs across the country. The Netflix special is the 1% of jokes that worked, the tail events. The rest, probably just okay in investing. Most ignore the role of tail events. When things go wrong, we overreact. But once you accept that tails drive everything in business, finance, and life, you realize that many things may go wrong, fail, or fall apart. Out of nearly 500 stocks Warren Buffett has picked, Only 10 generated most of his wealth. Good stock pickers are right only half the time. Good leaders make good decisions only half the time. Being wrong sometimes doesn't mean things won't work out in the end. Often, success is determined by just a few events. It's important to understand the difference between being rich and being wealthy. Richness is about income and visible possessions, the car you drive, the clothes you wear, the house you live in. Wealth, on the other hand, is what you don't see, the assets you haven't spent yet. True wealth is invisible. It's easy to assume someone driving a Lamborghini is wealthy, but appearances can be deceiving. Many people live beyond their means, using debt to fund flashy lifestyles. Wealth is not about luxury, it's about restraint. Every diamond ring, designer suit, or first-class upgrade you decline contributes to your long-term wealth. We're conditioned to believe that having money means spending it, but the real key to building wealth is saving and investing. In fact, the only way to be wealthy is to not spend the money you have next time you see someone with a fancy car or a big house. Remember, you can't judge wealth by appearances alone. The real keys to wealth are self-control, discipline, asset building, and investing in your future. Imagine climbing a mountain with the goal of reaching the peak and seeing the breathtaking view. Maybe the weather is sunny, maybe it rains. You might get lost, fall, or injure yourself. The difficulty isn't obvious until you're in the thick of it. Looking up from the base, the path seems clear, but along the way you'll need to change course. There's no golden escalator to the top, you know that uncertainty. And risk is simply the price of getting there. Yet, when it comes to investing, many believe they can avoid risk and get something for nothing. Housel compares investing to buying a car. You have 3 options: buy new, buy used, or steal it. Buying new means paying more upfront but expecting higher returns, like aiming for 12% returns in the stock market. Buying used is cheaper, but the reward is smaller, like safer investments, yielding 4%. Stealing is trying to get something for nothing, timing the market perfectly, buying before every rise and selling before every dip. Most people wouldn't steal a car. The consequences outweigh the benefits. But in investing, many try to steal from the market through shortcuts and tricks. They attempt to sell before a crash and buy before a rally, ignoring the emotional cost of volatility and uncertainty. Consider wanting to earn 11% annually over 30 years for retirement. From 1950 to 2019, the Dow Jones returned about 11% per year. But over those 69 years, there were many highs and lows. Many investors panic at the sight of fluctuating portfolios and try to jump in and out, avoiding the price of long-term volatility. Price of investing isn't just in dollars and cents, it's in emotions, patience, fear, and resilience. Recognizing that investing comes with a price is crucial. That price is not always obvious, but you must pay it, just like any other purchase. The key is to convince yourself that the fee is worth it, that it's an admission fee to a rewarding experience. There's no guarantee, but if you treat it like a fine, you'll never enjoy the journey. Finally, there's a powerful psychological trap known as the hedonic treadmill, or hedonic adaptation. Every time you reach a goal, you move the finish line further ahead. You need more, faster, better. Look at Bernie Madoff and Rajat Gupta, 2 ultra-wealthy men who committed crimes to get even richer. For them, enough was never enough. The endless pursuit of wealth and success without knowing when to stop is like climbing a ladder that never ends. No matter how high you climb, there's always another rung, and the chase can consume you, leaving little room for joy or fulfillment. Know when enough is enough. Understand that true happiness doesn't come from more money, but from contentment, freedom, and peace of mind. Money is not just a number. It's a mirror reflecting our fears, hopes, values, and dreams. Understanding how we think and behave with money is the first step toward financial freedom. Whether it's recognizing the power of compounding, embracing uncertainty, accepting luck and risk, or learning when to stop, the psychology of money teaches us that financial success is not just about math, it's about mindset. And that, in the end, is the most valuable lesson of all. If you found these insights on money, behavior, and long-term thinking valuable, hit that subscribe button now. Don't miss out on more life-changing ideas from the psychology of money and beyond. This channel is your guide to smarter decisions, financial freedom, and a richer life, not just in dollars, but in time, peace of mind, and purpose. It's not just about earning more, it's about living better. Start today.